let me just welcome in our global expert today, Alistair Williamson, analyst at Stockboard Asset, who's keenly, of course, been looking at global trends and is joining us today to share some of his views. Alistair, thanks so much for joining us. What's your outlook on global equities at the moment? Which way do you feel we're headed, given that we've been trading at those records as well? How much strength do you really see in the current trend?
I think what we have to look at is a much different picture to the global outlook than we saw in 1Q 2016. 1Q 2016 was a concerted effort by global central banks to pump liquidity into markets and create a synchronized growth pattern that we saw around the world. This time it's different. Central banks, their monetary toolkits are not as effective as before, and we are in a different pattern of growth around the world, which is a desynchronization that is in every corner of the world, from Asia, specifically Europe. If you want to dive into Europe, you would be looking at Germany's manufacturing complex, which is teetering on a recession, if not already in. Of course, China and what the trade war has done, which has destroyed complex supply chains around the world. Companies are reworking these supply chains, which takes a lot of money and time. And that is one of the reasons why we've seen a lull in growth. The outlook is, with many traders today buying equities around the world, is that a second half rebound will occur. I don't think that is going to exactly happen. And that is due in part to fiscal and monetary toolkits all around the world, not as effective as before. And where do I see U.S. equities, specifically the Dow Jones or the S&P 500, or even the NASDAQ 100? We have seen unprecedented moves. The slope of the move is unprecedented as well. The S&P is up 25% in 70 to 80 trading days. What I see is a resistance level nearing, when traders will have to take profit. Multiple years of gains have just occurred within the last quarter, and we do see a contraction or a retracement of the move.
So in that context then, Alistair, what's the strategy that you think is best at this given time?
So my overall focus as a macro strategist would be globally, but where I do trade and I do have open positions would be in the U.S. My advice would be, if you are buying equities or futures, specifically in DM, perhaps the U.S., you're betting on a second half rebound. You're betting that growth will pick up. And if that's not the case, there are going to be many traders who are very one-sided today. They're going to be very wrong. What do I see? Well, last month I sold a portfolio of blue chip stocks in around the 2,800 handle of the S&P 500. The advice I would have would be cash and treasuries. Those were the top performing assets of 2018 and will most likely be some of the top performing assets in 2019.
Right. Alistair, hi, morning. So which are the most interesting stock charts that you've come across in the recent times? Anything in particular, any themes that stand out?
Yes. So currently right now, one of my largest positions besides cash is a very large percentage of the portfolio, due in part to global uncertainties, so forth. I would say one of the best charts I've come across is the largest imbalance that we see in global markets, if not in just DM and US markets. That would be semiconductors. We started to initiate a short in SOXX, which is a semiconductor ETF here in the US. If we take a look at the underlying fundamentals of semiconductors, just looking at trade export data in Taiwan, South Korea, Singapore, we see depressing trade data, especially exports out of South Korea, and then also guidance from companies like Texas Instruments, so forth. We've seen these semiconductors, individual semiconductors, move up 30, 40, 50% this year as a bet on the second half rebound. But the most interesting chart would be the SOXX. It's one of the largest imbalances that we currently see in the market. It's moved up 45 to 50% in a matter of 70 to 80 trading days on negative fundamentals.
Right. Do you also foresee rotation from developed markets towards emerging markets? And if that's so, where do you see leadership emerge from?
So currently right now, we had this synchronized move from early 1Q19. That synchronized move was basically in global equities. I would say primarily that was the bet on Chinese stimulus, massive stimulus in January, I think upwards of $1 trillion USD. What's happening right now is that we're starting to get fears that the Chinese stimulus maybe is not being that effective, maybe as effective as we saw in 2016 or late 2015. What we're seeing is emerging markets, BRIC countries, we're starting to see the equities starting to weaken. Along with U.S. and along with the strong dollar, which the dollar is going to go much higher, we think that a rotation from DM to EM is maybe not likely, and possibly we're going to see leadership continue in DM. That's going to most likely be the U.S., but nevertheless, we see EM and DM, those equities hitting resistance levels currently.
Right now, Alistair, recently the inverted yield curve was much spoken about, and in the past as well has led to quite a bit of a recession in the US. Do you think that a recession will now follow? And in case of that, where do you see the markets headed?
So with Nifty, it's up close to 18% in 122 trading days, I believe, since October. I think it's only as effective as how much the RBI can provide liquidity to the market. We do see current liquidity injections ahead of the elections. But anything today, I believe, if it's India or the rest of the world, it's how effective can that central bank be, not necessarily what the fundamentals are.
Right. Okay. Now, crude as well has retraced the key Fibonacci level of about 61.8% of the previous fall. What is the outlook on crude, Alistair? Where are we headed?
So what we're seeing in West Texas Intermediate, or just Brent, is a massive retracement of the move that started a deflationary trend in the, we'll call it maybe September, October timeframe. A lot of that move, I would say, is on the idea of rebalancing. But what we're starting to see today, that it's starting to be more geopolitical oriented, specifically with Washington and Iran, and Washington's attempt to stymie any type of export of oil from Iran. Which has led to a recent surge in the past week or two, with the Fibonacci level tagging the 61.8, and I'm just looking on the monitors here of NYMEX light sweet at 66 handle and ICE Brent crude at 75 handle. I think we're going to start to see resistance, and that's going to be because of the dollar. As well as perhaps when slowdown fears reemerge with global investors, oil is one of the first to see a downward move. But overall, with oil, I think the move is going to be fairly limited with a strong dollar. But nevertheless, what we have is an administration that has sparked geopolitical fears. It's done on purpose to raise oil prices, and that can certainly go higher. It's really up to the Trump administration and what they're doing with Iran.
All right. Any other commodities you're currently looking at as well? What's on your radar right now?
Yes, I do. So when we want to look at industrial metals today, industrial metals, if you're looking at the S&P GSCI index, are currently coming under pressure. I think that could go to that could be a resemblance maybe of slowdown fears that are starting to emerge. Specifically, rolled coil steel here in the U.S. Is starting to and is starting to roll over. The idea behind that is auto manufacturing is quite depressed here in the U.S. That's actually some of the issues that are occurring. Is auto and manufacturing are leading the slowdown here in the U.S. So with the commodity front, rolled steel would be rolled coil steel would be a very I would say one that one should look at, as well as just understanding where industrial metals are going. When it comes to precious metals, gold and silver, we don't have any positions in that. The idea is that we think the dollar is going to go much higher.
Okay, so not really expecting it to go much higher, but what's the trend that you're looking at when it comes to the dollar index in the near term?
Great. So we just broke the 97.5 level on the dollar. The dollar is going to go much higher. There's a dollar shortage crisis that is currently underway. It's been underway for some time. What we see is trillions of dollars in dollar-denominated debt around the world, and we see not enough dollars to supply countries or so forth. But the dollar is going to go well over 100 to probably the 101 to 103 level. There is a breakout that is currently underway, and it could be on a technical, it could be on a short squeeze. But more than likely, there is a dollar shortage that is currently underway here. And that's why we see a tick up in the dollar from the 97 handle to the 98 in the last few sessions. It's been a very large move here. And that is going to certainly weigh on EM currencies around the world, EM markets. So as long as the dollar is strong, which it is, and it's going to be much stronger, there is going to be EM issues and maybe thwart or prevent that DM to EM rotation.
Awesome, Alistair. Thanks so much for joining us and taking us through your views on a whole host of things today. Great to have you with us here on ET Now.